Ladies and gentlemen, thank you for your patience in holding. Your conference will begin in approximately 1 minute. Ladies and gentlemen, thank you for standing by and welcome to the third quarter 2014 earnings results conference call. At this time, all participants are in listen-only mode. Later, we will conduct a question-and-answer session, and instructions will be given at that time. Should you require assistance on today's call, please press star then 0. To ask a question, please press star 1 on your touch-tone phone. And as a reminder, this conference is being recorded. I would now like to turn the conference over to your host, Mr. Jack Collins, Denbury's Executive Director of Finance and Investor Relations. Please go ahead, sir.
Okay, thank you, Zach, and good morning, everyone, and thank you for joining us on today's call. Presenting today from Denbury will be Phil Rycook, our President and Chief Executive Officer, Mark Allen, our Senior Vice President and Chief Financial Officer, and Craig McPherson, our Senior Vice President and Chief Operating Officer. Before we begin the call, let me remind you that today's call will include forward-looking statements that are based on the best and most reasonable information we have today. There are numerous factors that could cause actual results to differ materially from what we discuss on today's call, and you can read our full disclosure on forward-looking statements and the risk factors associated with our business in our corporate presentation, our latest 10-K, and today's news release, all of which are available to you on our website, denbury.com. Also, during the course of today's call, we will reference certain non-GAAP financial measures. Reconciliations of and disclosure on these measures are provided in today's news release. With that, I'll turn the call over to Phil.
Thank you, Jack. Let me begin by talking just briefly about the current macro environment. As everyone knows, the oil price has dropped considerably over the last couple of months, and WTI future prices are now below 80, both short and long term. Correspondingly, the equity valuations of oil companies have dropped significantly, including ours. I wish I knew what the oil price will be going forward, but to be candid, I do not. There are some that suggest prices could drop more, and others presume prices have hit the bottom. In any case, though, let me highlight why I think Denbury is well situated to weather this price dip. Denbury's assets and strategy put it in a uniquely positive situation under these circumstances. As we have historically stated, we believe we could cut spending by almost 50% and hold production roughly flat. In other words, we can reduce our capital development program significantly without shrinking the company. Some think that once you start an EOR flood, you can't stop or slow down development. That simply isn't true, as we can adjust the development pace to almost any rate. We don't have any lease expiration issues like most of our peers. Our assets will not go away if development is slowed, and really the only negative impact is the decrease in the present value of the cash flow streams. In addition to the advantages inherent in the assets, we've been hedging a portion of our forecasted production 12 to 24 months into the future fairly consistently for the last several years. As such, we have about 75% of our current oil production hedged through the third quarter of 2015, with a bit less hedged from the fourth quarter of 15 through the first half of 16. About half of the 2015 hedges are swaps with prices in the low 90s, and the balance collars with a floor price of around 80. Lastly, our capital structure is such that most of our debt is termed out with attractive interest rates, lowering the risk that lower oil prices could impact the liquidity we currently have under our bank line. In summary, we feel very good about our ability to withstand lower oil price and believe we are in a better position to do so than much of the industry. Nonetheless, we are reviewing our 2015 spending plans in light of the current environment. The current oil price is about $12 to $13 a barrel below our stated 2015 budget price of $90. So that decrease does obviously have an impact on our projected available cash. As you know, we attempt to fund our capital spending and dividends with cash flow from operations, so we are currently evaluating our options for 2015 in light of the anticipated reduced revenue due to commodity prices. With our Analyst Day just a couple weeks away, we won't be addressing our 2015 plans on today's call, but suffice it to say we are acutely aware of the current environment and are evaluating our options. We look forward to providing you a comprehensive overview of our operations and 2015 estimates at our Analyst Day presentation in about 10 days. As you know, we've worked hard to reduce our cost in 2014, and that program is continuing. I'm pleased we have generated about $90 million of free cash thus far this year, over and above free cash defined as cash flow from operations over and above capital expenditures and dividends. And at least part of that free cash is due to our emphasis on cost control. As we announced during our last earnings call, we were running below budget on our capital spending, but noted we may rearrange some of our capital budget programs to end the year closer to the $1.1 billion budget. We anticipate we may spend at a somewhat faster pace in the fourth quarter than what we did in the first three, but we still expect to end the year a bit below budget with regard to capital spending. Therefore, even with the lower oil prices, we should end the year with excess free cash flow. If you analyze our LOE costs per barrel, they are down about 20% since the fourth quarter of 2013, and that's $22.86 per barrel this quarter versus $28.67 in Q4 of 2013. Unfortunately, if you dig a little deeper, it's not quite as good as that initially looks. If you adjust for the non-recurring items related to the Delhi incident, both including the insurance receipts and incremental charges, and adjust for the incremental workover costs at Riley Ridge, the net decrease per barrel is reduced. Interestingly enough, though, this year, while our ERR is running a little bit behind, primarily due to